Joining me right now is Pacer ETFs President Sean O'Hara. It is good to see you this morning.
Good morning. How are you?
Good. You know, we began the year with what felt like a different tone, a little more positive than the way we ended. Has sentiment changed in any way from your standpoint?
Well, I think sentiment is changing a little bit. I mean, you mentioned the volume number. There's just been no volume so far. There's just been much lower than. And I think people are starting to get a little bit of a wait-and-see attitude in terms of what's going to happen with China, with rates, with the Fed, with the government shutdown, and all these exterior issues that have some kind of a negative headwind on the markets.
Yeah, I mean, look, we're beginning earnings this week. That's going to obviously set the tone. Kicking off this morning with the banks, Citigroup is going to be reporting momentarily. It is reporting today. Then you got J.P. Morgan, Wells Fargo. Tomorrow, Bank of America. Wednesday, we will also hear from Delta, United Airlines, Alcoa, American Express, Netflix. So this is the beginning of a big week. Any anticipation there from your standpoint?
I think what you're going to see is the theme will continue. I think we'll get good fourth quarter earnings, and I think that there'll be more people that'll be revising down than we would have expected for all the reasons we talked about earlier. I think the Apple announcement and their reaction to what's going on in China and guiding people a little bit lower, I think is going to become a trend.
Meanwhile, the banks are really going to give us a window into how the consumer is doing, and so far the backdrop feels fine. I sat down with J.P. Morgan Chase Chairman and CEO Jamie Dimon last week. Here's what he said about the backdrop.
Stocks in America at 18.5 times PE, and now they're at 16. Sometimes there's a good reason for that. Slower growth is a good reason. People do have concerns about rising rates. They do have concerns about trade. I think trade has caused a lot of volatility in the marketplace. So sometimes that adjustment is reasonable. And prices now are more reasonable. And, you know, like with high yield, we had no bond issuance in December. My guess is you'll see something happen soon. And the markets kind of open up if they take a deep breath. And it looks like there will be growth. It's not like we're going to a global recession. We're going to have slower growth than maybe people expected a couple of months ago.
And yet there was no debt issuance, no high-yield debt issuance at all in the month of December. That was something that we zeroed in on. What do you think in terms of the earnings period? Does that change sentiment?
I think that the credit markets are trying to tell us something, both on the high yield side, on the leverage loan and the bank loan side, and on the Treasury side. If you look at what's going on, is that there was no liquidity in the market for some of those securities, and the prices collapsed. And then people flooding into the 10-year Treasury tells me that they're looking for a safer place to be, maybe for the time being, until we sort some of these things out. You know, the 10-year Treasury went from, you know, above 3 to like 270, I think, is where it hit. That's because people were piling money in, and then people piling money into an instrument that's going to give them a 2.7% return for the next 10 years tells you that something's going on.
Yeah, and you also have money moving into some ETFs like gold, right? I mean, people are trying to hedge their bets. What are you seeing in terms of the flows right now, or outflows?
Well, we're having a great January and a great beginning of the year. Our flows are going mostly into the trend-following strategies that we have, which is sort of a downside risk management play. But we're also getting flows into our cash cows series. So those are lower PE ETFs that have high free cash flow and high free cash flow yield and pay decent dividends and tend to grow their dividends over time and trade at a big discount on a multiple to the market. And so that, to me, you know, if I'm looking forward for the next 12 to 24 months, I think I'd be favoring value over growth. I think I'd be favoring small caps because of their relative valuation to large caps, and I'd be starting to think about, we talked about this last time, I got my head pounded in by some of the panelists, but international and global over the U.S. because their prices are just so depressed. So if you're looking forward, what you want to do is not buy what's priced in. What you want to try to do is be anticipatory a little bit. So those are the three areas that I think we have opportunity.
Yeah, I mean, the international story has been worse than the U.S. That's why I think people question, why would I want to put money in emerging markets right now? Look at China. Chinese government trade data released showed that Beijing actually had a record trade surplus with the United States despite the tariffs. Your reaction, and what do you think about the U.S. trade deal? How important is that going to be once we do get a deal on the table for markets?
Well, I mean, I think that's what everybody's hoping. I'm not sure that that's actually going to be the elixir that cures our woes, but that's what everybody's hoping. Once we get a deal with China, then it's off to the races. But I'm not sure that's exactly where we're headed. I think 2019 may be a little bit of a volatile and difficult year in the equity markets because we're in this transitionary phase. We had tailwinds last year in the equity markets, and we don't have those tailwinds this year.
You mean we don't have the tax cut plan?
That's exactly right.
That was the fiscal stimulus that really boosted markets last year.
Yes,
in 17.
And that's not here this year. And so where's that boost going to come from? Or are we going to go back into a more of a normal cycle, which is decent growth, as Jamie Dimon mentioned? And if that's what happens, then we sort of have to have a reaction to that from a PE ratio expectation. We're not going to get 20 times earnings on the S&P if we don't have that kind of a tailwind. And so we have to find our equilibrium, I guess.
Having said that, the Federal Reserve seems to be on pause right now.
That scares me more than anything.
It does?
I know everybody says that's good news, but if the Fed is reacting to the stock market and the stock market is saying that another 25 or 50 points, 50 basis point rise in the Fed fund rate is going to derail the stock market, that makes me more nervous than anything. I mean, I would hope.
Well, maybe the Fed is reacting to a slowdown that they're expecting across the world. I mean, a year ago this time, we're talking about synchronized growth. Now we're talking about pretty much synchronized slowdown.
Right. Yeah, it changes pretty quickly.
Yeah.
And so, you know, I just look at all of the exterior things, and I'm sort of a fundamentalist. I want to know what the earnings are, I want to know what the earnings growth are, and I want to buy companies that have strong balance sheets and they generate a lot of cash. You know, we had a huge win on one of the stocks that we own this year, Celgene. They got acquired.
Bristol Myers took it out.
And so those are the kinds of things that I think mean more now than anything is, you know, do we have solid fundamentals? Do companies trade at the right multiple? And do they generate enough free cash flow to operate their business? And can they be opportunistic with that free cash flow? And then more importantly, if we do go into some kind of a slowdown or Fed continues to raise interest rates, do they have enough cash to sustain that?
Yeah, it's a great point. Celgene, $74 billion deal, acquisition by Bristol Myers Squibb. Sean, it's good to see you.
Thank you so much.
Thank you so much for joining us. Sean O'Hara from Pacer.